Hello, Greg. Oh, I gotta turn my volume up. Hello. Can you hear me, Greg? Hello, hello. Hello, Greg. Can you hear me? Check one, two, three. What do I got going on here?
I can hear you now. Can you hear me?
Now I can hear you. Yep.
Yeah, no, I literally was just on a Zoom and it never fails. It always resets whenever it's like going from Apple to Google, or they intentionally throttle stuff back.
All right. How are you doing today?
I'm good. I'm good. We have an active market here, which is good. I mean, we're at one point July was limit up, touch limit up today. I think the consensus out there is that cash has bottomed. I know some of the bigs are getting hit on now. So, bottomed, I guess, is the million dollar question is, bottom to do what? I think with all assets right now, okay, great. We're done going lower for the time being, but what does that mean as far as upside potential now?
Exactly. But look, you can't sell lumber from an empty yard. So I was talking with a lumber dealer this morning, and these are times that are tough because you buy something, and you might be taking a loss when you go to sell it.
Yeah, and again, you can't sell something from an empty cupboard. I think again, if you're a Western SPF 2x4 guy, you're probably going to have to get, if you haven't been more proactive in your approach here the last couple of weeks with falling prices. The reality is the mills are going to play the game or get into the queue now, and there are still issues, significant issues from a rail car standpoint as far as stuff shipping on time. So I think it's one of those things where we've stressed this over and over. You got to run your business, not the industry's business. Run your business. And for those that potentially need to find prompt wood out of specific mills into specific areas, it's going to be easier said than done.
Well, let's get into it. Let's kick this thing off. What
Yeah.
what do we know this week?
We'll start big and then narrow our focus as usual into housing and lumber. I think the big thing that stands out on our composition chart here is that crude has finally given a sign that it could be topping out. And as a result, and again, you had a big corrective move where you were down $8 at one point on Friday. There really was no underlying cause rationale behind it. It just looked like profit taking. But as a result, now equities are trying to bottom out on this move. And then obviously lumber has come a long way here in the last week and a half, where you're basically up, you're officially up over $100 off of the lows now in July. And interest rates have kind of moderated to where they're done making new highs here for the time being.
Yeah, I know. I think the overall mood on the entire economy is, there was that fear we're going to go to, we're going to drive ourselves into recession. I'm seeing now one third chance we drive ourselves into recession by raising interest rates.
Yeah, I know Goldman had something out this morning where they increased their probability of a recession. I know JP Morgan put something out that if we were to go into a recession, then you could conceivably take another 15 to 20% off of equities, the S&P. So, a lot of what if scenarios to where, whether you're talking about lumber or equities or pretty much all the other assets out there, even Bitcoin seems to have found a bottom for the time being. But bottom to do what? Where the strategy still seems hope it higher to ultimately sell into. And I think you're going to need to see signs that inflation truly has topped to kind of change that perspective. And if we jump, the other two things that stood out to me, and I know you're a commodities trader, Mike. These indices have been around for a long time. This is the Goldman Sachs commodity index, and then this is the CRB Commodity Research Bureau index. And so, going back to the Goldman Sachs index, the index by itself is a huge component of the index. These are just a basket of commodities that they track, and you can actually trade these. These are futures contracts that trade at the CME in New York, which is owned by the CME anyway. But so the Goldman Sachs typically is more a stronger composition of energies. So even if you look at the red line, that's energy. You look at agricultural and livestock. I keep hearing people say, well, this is the direct result of the Ukraine. This is, the inflation being caused is more a function of the energy market. Well, here's Goldman Sachs, strip out energy, ag and livestock are extremely high. You've gone back, to where, you can see this goes back to 83. You're at all-time highs here. And then when you look at the CRB is raw industrials, to where I don't think this includes. This does not include energy. This is all raw materials, and you can see kind of the same thing. This goes back to 1952. Go back to the inflationary periods in the late 70s, early 80s. Again, you've surged to all-time highs here. So just to say that this is purely energy driven, that the idea, inflation will top when energy tops, I think that's a possibility, but it's probably wishful thinking. That there's just inflation abound, and it doesn't seem to be moderating, or all the data that I look certainly doesn't show signs of topping out here right now.
No, and I think food and gas are the two things that really affect people the most, obviously. I just was traveling this weekend. Gas is expensive, $5 a gallon. And we stopped for dinner, and all of a sudden the bill comes, it's $150 for 4 people. You're like, whoa.
Yeah, I've been flying a little bit more for work, and I'm going to traveling the end of this month, and I paid for a round trip ticket, and I'm not even flying direct. I'm going to Portland, a little over $1,200. That's before picking seats and all the fees that they get you with. But that's a lot of money just to say. You just say that's not going to impact how you travel, how you do things. Food and energy are huge components of everybody's daily life.
Yep.
And so, it's funny you bring that up. So the next chart, CPI 8.5%. Look at these top items. As everybody's getting ready to travel for the hot, summertime holiday mode. Look at gasoline from a year ago. Look at airfare. Look at hotel, motel. Look at food. It's just, mass transit. All these things are, look to move around to eat. Those aren't luxuries. Those are necessities. Sure, you can substitute, but a lot of the stuff you're going to be impacted regardless of how much you want to substitute or rein this in as far as spending. So, again, inflation seems to be outpacing wage, which I think is huge. So, again, we had this one last week. I still like this. Personal savings is starting to dwindle here. Inflation, durable goods, everything is starting to erode people's personal savings. So as we roll this into housing and interest rates and just ultimately into lumber, so far 2022 or 2022, record year-to-date increase in 30-year fixed mortgage rates. You're kind of showing no signs of moderating here so far. So again, when it comes to housing, and we saw this reflected in housing starts last week, where we talked about.
Well, let's just back up a second. Everything you just talked about means less dollars in someone's pockets to spend on something like a house, right? So there's just less money going after the ability to buy a house, which is kind of what matters to all of us because houses are made out of lumber. So yeah, going now, talking about not surprising, the starts numbers have come off.
Yeah, so I know a month ago we had talked about this chart, Mike, where you had this divergence between permits and starts, the blue lines, and housing completions, and how you were getting, this is a month ago right here, you were uptrending here, you were still building out permits and starts, completions was worsening, and we knew something had to give, and that was reflected in this last round of housing starts permits numbers, where you finally had permits and starts really start to see the impact of demand destruction. Completions, again, the backlog of business out there is still good, so where you're finally starting to see the convergence between permit starts and completions, somewhere in between lies the truth. And I think it's safe to say, you're probably still in that 1.55 to 1.6 on a aggregate type basis, as far as where reality is from a labor standpoint, from an interest rate standpoint. That's kind of what we'd like to see in housing starts versus the actuality of what we're going to see. I think that 1.55 to 1.6 area is sustainable for the remainder of this year into Q1 of next year. We'll see if inflation can moderate, if interest rates can moderate. But going back here, housing starts, now you're kind of back to here's February of 2020, start of the pandemic. You can see this trend line that's drawn here. You're back to pre-pandemic type housing levels right now. Whatever fluff was added in here with the increase in money supply, the Fed's aggressive spending spree, reality has reset us back as far as housing is concerned, back to pre-pandemic type levels now. And again, that's your 1.5 and a half type area. That's at least supported with the data that I look at as far as being realistic for the remainder of this year from a starts and permit standpoint.
I concur.
I thought this was good. John Burns, Real Estate Consulting. They put a ton of stuff out on LinkedIn. I would highly recommend anybody with housing exposure, single or multi, that you start to follow these guys, because they put out a lot of stuff, and you can see the red indicates it's cheaper to own. Blue indicates that it's cheaper to rent. And there was this small window with the onset of the pandemic where everybody and their brother had the same idea as far as, yeah, this is a great time for home ownership. And we've exploded now to the thing that stands out with this chart is that you're back above the subprime type highs of 2000, 2004, 2005. From a cost of home ownership, inflation has reared its ugly head, and it's not very cost effective to own a home right now, to buy a new home, unfortunately.
That's a great chart right there.
Yeah, yeah. So this is the other thing that kind of, and again, this is John Burns, but distribution of outstanding primary residential mortgages by interest rate. So 73% of outstanding mortgages are locked in at rates below 4%. So the idea of moving up, either, that vertical move from a housing standpoint, I think a lot of people are going to be locked in by virtue of their interest rate to, jump back. So with the idea that, okay, you've had home price appreciation, land appreciation, it becomes that much more expensive to make a vertical move from a housing standpoint. Factor in interest rates going from basically 3 5/8 to start the year, out over 6% or just below 6% as of this morning. It creates this idea that you're probably going to see more people stuck in their homes. And that's not necessarily a bad thing, especially if you've bought in the last couple of years, but it makes it that much more difficult to make that vertical move into something bigger or better, where a lot of people, from where they bought or where their interest rates are, to make a lateral move probably cost more money, let alone a vertical move right now.
That's interesting. That's a lot of mortgages below 4%.
Yeah. So I think I know with our main residents, I want to say we're locked in at we did a 15-year at like 2 5/8. I mean, like you're, realistically, are you ever going to see those numbers again? And historically speaking, we're still at the low end of how interest rates. Sub 6% historically is still cheap, but it's not as cheap as having the free money sub 3% on a 15 or 10-year, sub 2 3.5%, sub 4% on a 30-year. So it's again, these are all things that you just can't set aside and say it doesn't matter from a housing demand standpoint. And I think when we shift into lumber now, I think one of the things that I mentioned to you and Jory was is talking about, okay, we've talked over the last 3 weeks here what to look for as far as a bottom is concerned. Well, I think it's pretty safe to assume with lumber being up over $100 off of its recent low, we've bottomed. But now bottom to do what? And when I kind of look at the continuation and start to look at the charts now, obviously there's a lot of float to the upside. But the one thing that jumps out with me, Mike, from a demand perspective, is that for this market to ultimately go higher, unlike last year, the last 2 years, it's going to be less likely to be demand driven to get this up to higher numbers. It's going to have to be the responsibility of the sawmills and the supply side of the equation to rein existing supply, future production, where it's going to have to be more supply constraint shocks than any type of organic demand to support higher prices here. I think that's the one thing that jumps out, whether we're talking lumber or housing, that demand component that we've relied on in the last 12 to 18 months, I think is gone for the foreseeable future.
Yeah, there's no doubt. Demand has headwinds, and how is the market held in balance? It's the supply side needing to make the changes.
Yeah. So jump forward here. Here's a July daily chart. We've talked about kind of the moving averages last week. I know we were going to discuss Bollinger Bands, but at the very least, you can say that these red lines here are Bollinger Bands, and basically all a Bollinger Band is a moving average with the standard deviation on either side. So you can do, this is an 18 period Bollinger Band. So it gives you a standard deviation of 18 periods to the upside, +1 standard deviation, -1 standard deviation, and it's all based upon these time periods. But you can see how you kind of held the Bollinger Band low here, and now we're bubbling up. So this red line here is the red line is a Bollinger Band moving average. This blue line here is a 20-day moving average. So we're kind of back up into the first real band of resistance on the charts. If we look at the Fibonacci retracements, and that's something we can cover in the next next week or so, next couple of weeks. But what does this mean for lumber? Well, I think right now the upside potential is a 627 to 637. If you can break out above here, then you still have this gap area, and then you've got the old high here from May where you could get back up to 680 to 700, but that's technically the next bigger upside potential. If you can get July back above the 630 to 640, 637 area, then it opens up the next bigger band of resistance on the daily chart.
So let's take a look at some of the volume and open interest stuff.
Yeah, here's September, same kind of scenario. Seasonally, again, we talked about this. I'll just run through these real quick. We talked about bottoming into the third week of June, so we're right in line with seasonality as far as when we typically bottom. Same thing here. Again, we referenced these charts last week. I just left them in here. Futures curve still have that carry structure. So the cheapest wood is still prompt physical cash, July. And so you can see the big change here, and we'll see it in the spread chart, is the July contract now went to 20 over September. So on the way down before we bottom, that July Sept was 25 under. Now it's 20 over. And so the significance of the spread, here's July Sept, is that if you would have bought September when, or July at 20 under, your September contract has lagged July now by $40 a thousand. So that's the significance of understanding spreads, intra-commodity spreads, in that it tells you what's undervalued, it tells you what's overvalued. And so this July spread, we talked about, ultimately the commodity funds are going to have to roll their July position and or liquidate. I think you're definitely starting to see bigger signs now where the funds are rolling into September. And so July is the beneficiary of their short covering, where, July today's up 43.90. July did trade limit up at one point. September 603.20 up 33.20. So July is acting like a front month and leading the charge to the upside. And then here's Sepnov. We'll come back to the basis, but from an open interest standpoint, you can see as of last Friday, September finally overtook July. Open interest is starting to stabilize and lightly build here, which are also good indicators of a market bottom. We talked about open interest needs to start to grow. That makes any type of rally more sustainable. And then when we jump into the CFTC numbers, when I saw this was music to my ears. Again, this is as of June 14th, last Tuesday, but managed money keeps adding to their positions. So 488 up 50. The big difference is when you jump to the producer segment, commercial segment, commercial longs, commercial shorts, you're done with the annihilation of open interest on this move. You're gradually starting to build. Commercials finally see that a bottoming formation is starting to take effect. And so again, I still think this is the important segment to watch here, and that the LIFO, last in, first out type crowd, especially when the momentum stalls in their favor and starts to go the opposite direction. Commercials are more supportive of this move higher now. And this is the segment to watch. Are they going to roll all these Julys into September, or are they going to liquidate? And so when I go back to spread chart here, the upside potential of this spread now is somewhere in this $20 to $30 area. Maybe you could make the case for 40 over. It just depends on, are those funds going to roll, or are they just going to liquidate their Julys going into month end?
So, one of the things I see in the spread is it's short covering. It is people who want the current wood because they're buying for business. The business that we've seen on the platform, I know a bunch of it is covering business that's sold in the fall. We had some stud orders that was going to get put in a shed for a November job. I think there's a lot of people who are sitting back waiting for the market to pull back like this so they could start covering their needs. Now, what that does is it lessens the need come November or September. If people are buying in that September, that early fall need right now because they probably have money in it. I think that's why you're seeing September lagging. They just want their hands on the cash today.
Yeah, and I think that's supported, Mike, with the basis. When you look at July versus cash, again, basis is cash minus futures. You can see that July is trading at a slight, coming into this morning was trading at a discount to print. The reality is, I'm hearing the big sawmills are probably getting 620 today or greater. Futures is 625. So again, you've had that convergence. Even on this up move now in July over the last week, you've had convergence play out to where you are seeing a lot of people liquidate their futures position and go buy the physical cash, even if it's buying a little bit earlier. If you can take advantage of the convergence, and own the wood. It's okay, especially knowing specifically what items you're going to need and when you're going to need them. You can be a little bit more preemptive in covering that physical cash early and just taking the money out of the futures. If you fast forward to September, again, this is reflective in that the July Sept spread, where July is leading September now to the upside. And then here's November, where again, when you go back to this cost of carry structure here, the contango structure, you are going to pay up to own these back months now. November is basically even money with July, but there's still going to be some kind of cost to carry as the further along you go, where it still makes sense, even with the appreciation in futures off the lows, where if you can cover the physical cash and release the futures, you've got convergence playing out right now.
Yep, that makes sense. Absolutely.
So we covered basis, open interest. The only other thing I had, Mike, was rail car velocity, and that seemed to have stabilized. Obviously, the big news out there, and I know you guys referenced something on LinkedIn, but just so everybody's aware, I think it's the CN conductor electrical and conductor signal union went on strike. They gave a 72-hour strike notice last week. They officially went on strike yesterday. So that's definitely also, I think, at least psychologically, playing into futures being up hard today, where, when we look at we've definitely seen a significant improvement, but by no means is rail out of the woods. And the last thing you need is another issue with the CN as far as delaying shipments. Another reason where, if you're reactive to this market right now and you're purely a Western SPF player, I think realistically it's going to be easier said than done to get your hands on that prompt wood, where you're probably going to have to get into a queue.
Yeah. And the same thing on the trucking side. It felt like it broke free a little bit, and I thought rates were going to be coming down, and then they just basically hit a bottom, and the rates are what they are. It's somewhere around $4 to $5 a mile, just about for everything.
Yeah, and I'm looking. Matt Lehman asked any updates on the new impending truck-based contract for CME lumber futures. The answer is, I spoke with the CME last week. They're hoping to have something officially in writing and for public dissemination in the next couple of weeks. It's just ironing out the nitpicking formalities of a contract, but it's basically 95 to 90%, 97% there. Before they've got to get it to 100% where they're comfortable in getting internal approval from the CME to submit to the CFTC. Those are all things that happen fairly quickly, to where I'm being told, hopefully in the next 2 to 3 weeks at the latest, where there's actually something in writing that we can send out, that the CME will blast out there, where this becomes public news of what lies ahead.
Yeah, I'm looking forward to that new contract for sure. So to just kind of wrap up, where we are in the market, I think if you take a step back from this, markets go up when inventories are being built. Markets go down when inventories are being liquidated. We obviously just had a massive pullback on lumber prices from the Q1 into Q2. We liquidated a ton of inventory in there. So what I'm looking for right now is, can this new rally we have sustain itself? I question that, because the headwinds are there and obvious. I think, like you pointed out, Greg, the onus is really going to be on the supply side now. And they've gone full out up to this point. So, if they continue to produce at the levels they are, and the demand goes down, we're going to see continued pressure on this market going lower. So it will be very, very interesting here in the next, I'm going to say 3 to 4 weeks to see if these price levels hold or we build on them.
Yeah,
Because
and
it's not the known, it's always the unknown that gets you. So what is the unknown right now?
I think it's also going to be, when you look at kind of the other markets, and we've always talked about how lumber is heavily influenced by everything else, and are these temporary reprieves with the real lows still ahead of us? The answer is probably yeah. I mean, the one thing I follow some of these other kind of chart related indicators or services like Lowry, NeoWave is good as far as following equities. And the one thing that stands out from an equity standpoint is, this has been a painful decline in all NASDAQ, S&P, and the Dow, but it's been a very organized, non-chaotic decline. You haven't had any of these big seeming capitulation, touch limit type moves. Is that still ahead? And so I think lumber to continue to go higher needs less negative news from everywhere else so it can fixate on lumber. And if we're going to go higher, then I still think at the end of the day, supply is king here. It's not going to be the demand component is the savior for this market. It's going to be what's the willingness of the sawmills to curtail, to extend shutdowns, to take more shutdowns. How badly do they want to support higher price levels? And they're going to have to do the dirty work to realize that.
Absolutely. We back in March, I'm thinking February, March, we sat here and said, look, the futures market tells you don't buy wood right now. Wait, or buy futures. It was the cheapest thing. The market is slightly mildly telling you right now, so, wait for September wood. Not by a lot. It's, it's at $20 discount is only the Sept to the July contract, but that's what it's telling you. Whether that's right or wrong, I don't know, but I'm very cautious on this rally. I think that's where I'm getting at.
Yeah. No, I'm in complete agreement. I know Matt referenced, July is the vacation, mill downtime, summer bump, no legs, and I agree. I think that this market's going to have to do a lot to convince people to chase momentum. I think at the very least you've had short covering now in physical cash, but to build out inventories, I think it's going to have to be highly specific, whether you're talking about economy grade, number 3, 6-inch stuff that truly is trading below cost of production type levels. Everything else, when you look at, okay, this is the seasonality, but look at historical, price levels, the last, 3-4 years, but then look at the 3-year, 5-year, 7-year, 12-year averages, you're still substantially higher than average price levels. And in a market where you don't have the luxury of falling back on demand to drive markets higher, and you have to rely on the supply constraint scenario, why can't you ultimately see these lower numbers as you get into the seasonal lows of October, November? I think unless there's significant changes to the supply side of this equation, the reality is the real lows are still ahead of us. They're not behind us in lumber.
Well said. All right, let's jump and take a look at Bollinger Bands real quick here. You referenced Bollinger Bands quite a bit with your analysis, and I think the Bollinger Bands are so valuable for what they are. By this, what I mean is, first off, the website I'm showing you right now is literally bollingerbands.com. And John Bollinger created this theory on analyzing a market. And as Greg pointed out, it is nothing more than a moving average, but shifted up and down by a standard deviation. So what that ends up doing is it allows you to see, in the current market conditions, are we in kind of overbought or oversold, or what's the relative value of where the market is based off of recent history. And you'll find, like in downtrending markets or in a trending market, up or down, as you hit the Bollinger Band, it becomes, at the, how does he say it here? The upper band or the high, that it, on a relative basis, it could be expensive. Or if it's in a downward market and you hit that lower Bollinger Band, it could be time to be buying because it's cheap relative to the recent history. So it ends up, kind of wrapping in a little bit of momentum and oversold, overbought conditions.
Yeah, the other big thing, Bollinger Bands are one of my key technical indicators that I utilize along with moving averages. And I've talked about this with moving averages, the slope or the direction of the movement, I think, is critical. And with Bollinger Bands, they're really good indicators to tell you, can a market break out to the downside or the upside, or is it going to run into resistance where you just stop people out in either direction and then reverse and go back in the opposite direction. And I think a lot of that has to do, when you're talking about Bollinger Bands, how they converge and how they diverge from each other. So you have with the Bollinger Band, and Mike, if you want to switch back, I'll just kind of
Sure.
point. Yeah. So this is the September daily chart. And again, the Bollinger Bands here are the red lines. Let me see if I can I'm going to pull something up off of my CQG here to make it maybe a little bit easier to see. Hang on one second here. Okay, this has got less noise. Let me know.
Yep, you're on there, so you can make that big.
Is that good?
Yep.
So again, these red lines here are your Bollinger Bands. This is a daily continuation lumber chart. And so you've got the low band, you've got the moving average of the Bollinger Band, and then you've got the high band. Again, these are 18-period Bollinger Bands. And so what I'm always looking for is when the bands converge and diverge. So here's a perfect example here where the bands started to churn in on each other and started to converge. This usually is a really good indicator that the market is going to attempt to have a bigger breakout. And so you could see how the upper band, the lower band were converging in on each other. You finally had a breakout day. You closed under the Bollinger Band low. This generates a sell signal. But more importantly, to back that up, look at these moving averages. We've talked about the moving averages. Here's the 20-day. Here's the 44-day. Here's the 9-day. All these moving averages have a down slope to them. So in a market that's going to attempt to break out to the upside here, I want to be very careful that that's got the staying power to support that breakout, because you're fighting against the negative slope of these moving averages have rolled over. So it's more likely to support a breakout to the downside, where I'm going to use those moving averages. I'm going to use the Bollinger Bands to kind of support that move, that attempted breakout here. And then you can see as you break down here, you start to see the Bollinger Bands widening out. And so as those bands widen out, eventually that slope bottoms out here. It becomes much more easy to support some kind of a bottoming formation when the band's not plunging lower like this.
The thing that I like to look at in using Bollinger Bands especially is it's not the knowns in the market. Like you and I can sit here for a half an hour and talk about all the knowns. It's the unknown. So after you've done all your analysis and you find yourself still potentially going through these Bollinger Bands, that's when it really trips something in my mind to say, hey, wait a minute, what am I missing? Like what's out there that is driving this market that is an unknown to me, at least. So that's something to put in the back of your mind. Bollinger Bands, it's almost like the road that you need to drive on. And if you fall off the road or you get in the ditch, and outside the Bollinger Bands, it really goes, hey, wait a minute, what's going on here? I'm missing something.
Yeah, absolutely. Absolutely. So again, this is just another tool in the toolbox. For me, Bollinger Bands are a primary. I use Bollinger Bands to generate buy and sell signals, not just in lumber, but the other markets I trade. And, again, at the end of the day, technical analysis is great. It's always go back to point out, yeah, see, I told you, look, this is the market did this, but nobody's paying us for the left side of the chart. It's trying to predict the right side of the chart as far as what's the market likely to do next. And that's where these indicators become helpful tools, along with the fundamental perspective of what's going on in the underlying market you're trading. Am I trying to buy, at crude oil at this point at $120? Look, if I think it's going to $150, great. But am I trying to take breakout new highs in crude oil as far as buying crude oil, or fundamentally, okay, we're starting to sow the seeds of demand destruction now. The economy's weakening. That's going to impact demand. Maybe I want to start fading new rallies or attempted new highs in the energy market. These are all things that have to be analyzed and factored in. And lumber is no different. I think you have to have a good perspective, an understanding of fundamentally what's going on with supply and demand, but then also using the charts as a good real-time indicator of how I should actually be implementing trades or ideas.
All right. Well, we've hit our time limit. Let's wrap it up. Everyone have a safe week. We'll take a look next week. We're going to be just a couple days, 2 days away from no limit in July after next week. So we're going to see July start to become less important and September to become more important.
Yeah. Thanks, sir. That's good stuff. Good point.
Yeah. All right, everyone. Take care. We'll see you guys next week.
Thanks a lot, Mike. Thanks, everybody. Take care.